Of the staff, management, or ownership of this station.
It's time to get on the right path with Right Path Real Estate Radio with Jason Bible. Get the answer to your question that's keeping you from taking action and succeeding today. Get ready. The guy that will put your fears behind you is on the air now. Taking calls at 713-785-1817. Toll free 877-881-0271. Now here's your host, Jason Bible.
Hot mics.
Welcome to the show. Welcome to the show. This is not a pre-recorded show. It's December 28th. It's the last day, the last business day of 2017. It's been a great year for Houston house buyers. It's been a great year for Right Path Real Estate. Been a tough year for Houston. But I'm going to talk a little bit about the year in review and then a little bit about what's going to happen in 2018. So let me tell you what's happened since I was on the show Wednesday with Tom. We had a great event last night. We had a couple of things going on last night. We had a free event last night where we share with folks how we do our business, how we build wealth and income through real estate. If you're interested in attending one of those events, we have them every Thursday. Go to rightpathrealestate.com. You can sign up there for the next one. So we had a great event. We had 20, 30 people here. And I was next door at Carrabba. So our office is right next door to Taco Cabana here off of I-10. If y'all are familiar with the Energy Corridor, we're right across the street from, there's a Discount Tire over there in West Houston Archery, just outside the Beltway. And Carrabba's is like one, there's Taco Cabana and then there's a Carrabba's right there. So we got the private room. We invited all of our Base Camp and Pathfinder people. Those are the folks who are in our coaching program. And it was a lot of fun. We had a great dinner. We had a fantastic time. It was a lot of fun to get to hang out with folks outside of always working on our portfolios. So had a great little holiday into year party, got to talk some business. We're talking about money and deals, and a lot of the coaching folks, they were catching me up on the deals they're doing. It's really interesting in Right Path when we've got folks that are in our coaching program. We'll see them for the first 12, 18, 20 weeks, and they get so busy doing real estate they can't make it to all our meetings, but all of our meetings are recorded so they can go back and watch them. So it's fascinating to catch up with some people who are, we've got some people that bought 15, 20 houses this year, and it's their first year in real estate. So it was a heck of a lot of fun to be able to hang out with everybody last night. So we've got some friends of ours. Y'all are going to love this. We have some friends of ours that are taking some classes from another real estate education company. It's a big national brand, and they're here in town, and they're taking some classes, and they called me last night and said, hey, what do you, this is what we heard. What do you think? And I want to explain something. People teach real estate in a couple of different ways. We teach real estate very differently than most real estate education companies out there. In fact, we're 180 degrees different than anybody else. And so the most alarming thing, and I'm just going to talk about this just briefly on the radio show because I want you to be aware of what's going on. I just want you to be aware of some of the dangers in how people structure their businesses. So there was a speaker presenting at an event. Again, this wasn't our event. This was somebody else's event, some big national education companies in town. And they were talking about HELOCs, home equity line of credit. So essentially what you do is with the equity in your house, you're able to get a HELOC loan. You're able to get cash out of your house. And bankers love giving HELOCs. They love it. HELOC is just awesome for bankers. And why is that? So this guy that was on stage was talking about how you can take a HELOC out to invest in yourself and invest in their coaching and real estate education program. You could use a HELOC to invest in real estate deals. You could use a HELOC to go out and buy another house. You could use a home equity line of credit for a lot of different things. And banks are very willing to give you a home equity line of credit. And here's the reason why. HELOCs, if you default on a HELOC, a bank has more options than a traditional mortgage. Let's talk about what happens if you default on your house. If you no longer make your house payment, the bank starts sending you nasty letters. It says, hey, you got to pay us. They're actually called demand letters. So they send you a demand letter. And then at some point, they decide to foreclose on the house. And there's a whole legal process that has to occur there. And then at some point in the future, depending on how fast they can take it through the foreclosure process, you will eventually be kicked out of your house and lose the house. And then typically that's kind of the end of it. Your credit gets ruined. There's some personal income tax implications there. But typically that's about it. You lose the house and you're kind of beat up financially for about 7 years. A HELOC is a little bit different. So in a HELOC, you can foreclose, but lenders can also go to court to get judgment against defaulted borrowers and garnish their wages. So bankers love HELOCs because they can take the house and they can go after your wages. And so I had just heard this, and I want to talk about this on a radio show today because most people don't know this. But HELOCs can be incredibly dangerous to you personally. So if you're investing in real estate, if you're investing in real estate education, all that stuff, just know that if you're doing it with a HELOC, you're taking on a lot more risk than you realize. Those HELOCs can be a very dangerous weapon. In fact, I would argue if you're somebody that doesn't have the cash to invest in real estate education, to invest in deals, in other words, you're broke. Let's fix your brokenness before we go in and do real estate. So one of the things I absolutely love to say with somebody who's got very little money or who doesn't have really great credit, which totally happens. I totally get it. Right? Not passing judgment on anybody, but that's just, I get it. Some people listen to this radio show, you're just not in a position to go do real estate. Now, if you listen to some of my contemporaries, they'll tell you, oh, you can do real estate with no money and no credit. And although that is technically true, it's incredibly difficult. And just being 100% transparent here, if you want to build wealth with real estate, you really do need to have good credit and you got to have some cash. So if you're one of those folks that has some financial challenges in the credit department, in the cash department, let's fix your house before you go fix someone else's. Let's fix your house. Let's get your house in order. And here's one reason why it's so important to get your house in order now. I know people who were struggling, started a business, became extremely successful, made a lot of money, and continued to spend more than they earned. You can make $1 million a year and spend $1.5 million. I've seen it. I've had conversations with these people. You can also make $60,000 and live on $20,000. And you can take that $40,000 and invest, and you'll be much more wealthy than the guy spending $1.5 million making $1 million in a year. I mean, I've seen both extremes. Although we work in RightPath with a lot of the folks in the second example, that make $80,000, $90,000, $100,000 a year that live on $50,000. So just to give you a little transparency into our group. But here's what I'll tell you. We got to fix your house before we fix someone else's house. And if you want some help on that, if you want some financial education, some nuts and bolts, practical financial education, send us an email, support@RightPath Real Estate, and we've got a program for you. Again, that's support@rightpathrealestate.com. But if you're one of these folks who's got not a whole lot of money, not great credit, let's get that fixed. Let's not go tap our home equity line. Let's not get a home equity line of credit so that we can go do real estate. Let's not go get a credit card leveraged to the hilt at 18, 19, 20, 30% just so we can go do real estate education. Let's get your house in order. Let's get your house fixed. Because the problem here is not, it's not that you don't have any money, and it's not that your credit is bad. That's really not the problem.
2 minutes.
That's a symptom. That's a result of something else. Let's fix the something else, and as we fix that something else, your finances will improve. So it doesn't matter if you make $10 million a year or $10,000. If you spend more than you earn, you can't build wealth. It's impossible. My dad sent me a text message yesterday that Tim Cook, who's the Apple CEO, got a $100 million bonus this year. Not bad. But if Tim spent $120 million, now I don't know what his salary is, but if Tim spent $120 million this year, he's $20 million in the negative. He needs some financial education. As an example. So it doesn't matter how much money you make. That's not the problem. The problem is how you manage the resources that you're given.
1 minute.
And there is nothing more heartbreaking financially to watch someone who is financially successful, to watch someone who's in the top 1% and who's broke. And it ain't student loans. It's consumer-related spending. If they just saved a little bit more money, if they were just a little bit more conservative, they'd be so much more wealthy. If that describes you, send an email over to support@RightPath Real Estate. We got a program for you. When I get back from the break, I want to talk about the market in 2017 and prediction for 2018. It's Jason Bible, Right Path Real Estate.
Mike's off.
Investor loans offering up to 100% financing are still available. You just have to know where to look. Look no further than Noble Mortgage. Noble Mortgage is a full-service mortgage company that's been helping investors since 2003. Noble Mortgage offers up to 100% financing to investors that covers purchase, repairs, and closing costs. In addition to private money, Noble Mortgage offers conventional loans, FHA, and even no-income documentation loans for both residential and commercial properties. Call and ask about our 5-point guarantee, which includes free pre-qualifications within 2 business days. Call 713-680-8100 or visit noblemoney.com. That's noblemoney.com. Our team has over 50 years experience in the mortgage
Merry Christmas,
industry.
John.
Call us today, 713-680-8100 or visit us
Yeah,
on the
that's
web,
right, Brian.
noblemoney.com.
They got the Lambo, bro. Hey, John. Lambros. All right, so one of the things I've got to get done in 2018,
Do you have cracks in
I
your
need to
brick,
do a
walls
parody
that stick,
video. I
or
just
sheetrock
haven't had the
that's
time to
coming
write it
apart?
yet.
You may have foundation movement. Due to our expansive soils in the Houston area, it's probably not a question of if you have movement, but when.
Hey, Nikki, you
Call
want to do the
Foundation
Wednesday
Check
show for
a
Monday?
truly independent,
Yeah, I can do that.
unbiased
Okay.
foundation evaluation. Foundation Check has been in business since 2009 and has completed over 1,400 evaluations. We're not in the business of repairing foundations or selling you unnecessary peer work, but we are in the business of evaluating your foundation. Our product is designed for households,
Oh, the Lambros.
or even owner-occupied properties. Each
Thanks,
of our
Tang.
files is reviewed by a licensed engineer.
The
Remember to check
Lambros.
before ever repair. Call 346-702-3825. That's 346-702-3825. Or you can reach us online at foundationcheck.com. That's foundationcheck.com.
Time is money in a real estate deal. If your insurance company is slow or non-responsive, you could lose a deal like that. You need a quick turnaround on quotes or binders? The agency for that is Benchmark Insurance Group of Texas. The team at Benchmark understands the investor mindset. They know what you need and when you need it. We're here for you. Are you a rehabber, wholesaler, buy and hold, or flipper? Bundling your properties on a single policy will help save time and money. Benchmark has been in business for over 10 years, and we insure over 30,000 properties. Contact Benchmark about our exclusive investor package. Call us and let us show you what we can do for you at 281-569-4353. That's 281-569-4353. Or online at benchmarkbroker.com. That's benchmarkbroker.com. That's 281-569-4353. Or online at benchmarkbroker.com.
Are you looking for an investor-friendly general contractor for your investment property? Then call Fast Track Remodeling at 832-742-9992 or reach us on the web at fasttrackremodeling.com.
Fast Track Remodeling specializes in turnkey remodeling of single-family investment properties. Whether it's a flip rehab or a rental rehab, we manage every aspect of a rehab from start to finish with a highly efficient, standardized process.
Over the last 6 years, Fast Track has completed over 700 projects, which has helped us to create our 3 keys to success. Use a detailed scope of work so that everything gets done, train and maintain quality crews so it gets done right, and complete the work in a proper order so it gets done fast.
No more managing it yourself, no more doing the work yourself.
Come on.
Fast Track Remodeling really does manage it all.
So give us a call today at 832-742-9992. Again, that's 832-742-9992, or reach us on the web at fasttrackremodeling.com.
This is Business 1110.
Call Jason at 713-785-1817 and look for us on Facebook Live at facebook.com/RightPathRealEstate.
Hot mics.
Welcome back. Jason Bible, Right Path Real Estate. Let's talk about what's going on in the stock market. 2017 is a very interesting year. Something happened on the Dow that has not happened in 100 years. There's something that happened, and it happened today, that has not happened in the last 100 years in the history of the Dow. Does anybody know what that is? Anybody? Bueller? The Dow has not experienced a single down month. In other words, a month with a loss. 12 straight months of gains. That has not happened in the last 100 years. Now, can we be really honest with each other here on the show today? I would love nothing more than to say, hey, that was Donald Trump making America great again. But we need to be very intellectually honest. And we know that's not the case. Since 2008, 2009, during the transition of George Bush and Barack Obama, was the start of the financial crisis. They injected, along with Congress, $700 billion through the omnibus plan, the bailout, if y'all remember that. The bailout didn't stop there. And the bailout just didn't start and stop in the United States. There's an extra $200 trillion in debt, in money printing, that has occurred across the world. That money is ended up somewhere in assets over the last 10 years. Almost 10 years, about 9 years now. And I can tell you this, that has absolutely had an impact on asset prices. It's amazing to me how this year has shaped up from a capital and finance standpoint. It's amazing how much money has blown into the system. In fact, to give you an idea, I'm reading Dave Collins' article here. He makes a great point about this. Regression to the mean is a force of nature. It is also a mathematical truism that markets reside below the mean for half of their price-weighted existence. Let me explain what that means. In order for there to be an average, the mean, that means asset prices spend half of their time above the mean and half their time below the mean. That should make complete sense to everybody. In order to be average, there's a time period in which they're above the mean and a time period in which they're below the mean. Ergo, the average, right? The failure to go through the mean in 2009 is an anomaly caused by global central bankers that remains as an IOU on investors' balance sheets and foreshadows trouble to come. What does that mean? It means that we were supposed to experience a really brutal, actually short from a lot of economists' standpoint, short and brutal recession in 2008 and 2009. And because central bankers injected liquidity into the system, it really wasn't even liquidity, it was really just propping up assets. We were not able to go through that downturn. In other words, we were not able as an investors to experience asset prices below the mean. So what does that mean? What it means is that those losses are going to occur sometime in the future. Because mathematically, we always regress to the mean. It's like picking up a new habit. It is December 29th, December 29th. How many of y'all are going to be in the gym on January 2nd? Let's say you're 50 years old, never been inside a gym, and January 2nd, by golly, I'm going to be in that gym. How many years of consistent workouts at the gym do you have to experience in order for your entire life to meet the average of going to the gym, let's say, twice a week? For 50 years, 0. Now we're starting to work out in the gym, January 2nd. It's decades. It's like getting a 0 on an exam or getting a 0 on a number of exams. Let's say 10 exams, you get a 0. And then all of a sudden you do the next 10 exams and you get 100. What's your average? A 50. And a 50 is still failing. We have enough data, and in this particular article, I'm going to talk about it here in a second, as it relates to GDP. We've got centuries worth of data that tells us where the market should be at any one time. Now, does it go above the mean? Absolutely, but it also goes below the mean. If you want to see some really scary stuff, start researching pensions. And what's going to happen to pensions? Pensions for the last 50 years have assumed a 7% annual growth rate. And nothing could be further from the truth. In fact, when you start looking at pensions and assume a more modest 3% growth rate, a lot of these pensions are well underfunded. And, of course, next question is, Jason, what pensions are you talking about? And I can almost unequivocally say all of them. Corporate pensions, state, local, federal pension. I mean, all these pensions are a mess. And don't get me wrong, are politicians to blame for some of this? Sure, they are. Of course, I could also say that so is the electorate. Politicians promised you gifts from Santa Claus, but nobody ever said, hey, where does Santa Claus get his money from? I always love the idea of the Social Security lockbox. All that money was spent. And you sat there right along, voted right for those people that were going to do it. And yes, both Republicans and Democrats did it. So reality is those pensions are not there anymore. We will regress to the mean at some point. And I can tell you right now, the mean is not month-over-month gains in the market for 12 months straight. I read a stat the other day. If you guys are familiar with VIX, which is the volatility index, somewhere between 94 and 97% of VIX trades are shorting VIX. Think about that for a minute. 94 to 97% are shorting the market. What happens when it whipsaws the other way? If you look at the FANGs right now, that's Facebook, Amazon, Netflix, Google, and of course Microsoft. FANGs plus M, Microsoft as well. You'll notice that there are a lot of index funds that are essentially pumping up those share prices. When it's all buying, the price continues to appreciate. Go back. I'm telling you guys, look, everyone's off for the next week or so. I know kids here in Houston don't go back to school until the 8th. Either read or watch The Big Short. Because the whole premise of that book, the whole premise of that trade was not when is housing going to crash. They really weren't betting on a housing crash.
2 minutes.
It worked out that way, and they thought, oh my gosh, if it crashes, we're going to make a ton of money. But the bet, the trade, was housing was no longer going to appreciate. House prices were no longer going to increase. That was the trade. The trade was not, oh my gosh, the whole world's going to implode. Because if you watch that movie, and they show it really well in the movie, when the market really starts to fall apart, they're like, holy cow, we knew it was going to be bad. But this is going to be a bloodbath. Their bet was no longer, it was not going to appreciate anymore. There were no longer going to be price increases, mostly in the sand states. So this market, I'm not a market guy. Just assume I don't know anything I'm talking about. But here's what the data says. The data says we're at near all-time highs.
1 minute.
The data says they're $200 trillion. $200 trillion worth of financial finesse that's been injected into the market. And we know that's gone somewhere. The easiest place for it to go is in financial assets. When we get back from the break, I'm going to talk more about debt. I'm going to reference Dave's column here a little bit more. And we're going to talk about what the impact is in real estate. It's Jason Bible, Right Path Real Estate.
Mike's off.
You found or inherited a great investment property. Problem is, you don't know how much it's worth, or more importantly, what to do to maximize your investment while mitigating risk. This is exactly why we started Next Gen Appraisals.
Happy New Year, James.
Appraisers specializing in investment real estate. We understand that investors aren't just looking for a number of what their property is worth, but a comprehensive analysis of the market. Give NextGen a call at 713-346-9911 or check us out online at nextgenappraisals.com.
Taxes. Just the sound of that word makes people cringe. At Anderson Advisors, we provide tax reduction through asset protection for real estate investors throughout the country. Our unique philosophy has CPAs, lawyers, bookkeepers, and estate planners with one common goal, helping you, the real estate investor. Check us out today at AndersonAdvisors.com. And don't forget to tell us you heard about us at Right Path Real Estate.
Did you know that there are over $24 trillion in retirement accounts in the U.S.? Imagine if you could use someone's IRA to fund all of your deals. Well, you can. Quest IRA is based locally here in Houston, Texas. At Quest IRA, we offer retirement accounts that can be used to invest in real estate, promissory notes, private entities, and much more. Many of our clients
Eric, I completely forgot about that.
fund real estate deals all over the country.
That's
We
pretty
don't sell any
funny.
investmose or give advice.
Yeah, the
However, we do
landlord whose
hold
property's
free
in his
networking
dog's
events,
name.
weekly
Well,
educational
who was it? Was
classes,
telling me they were
and
getting
free
credit card offers in the
consultations
name of
with
their
an IRA
dog.
specialist. For more information,
I'll have to
visit
find
our
that somewhere.
website at
It's pretty funny.
questira.com or call us at 1-855-FUN-IRAs to tap into the $24 trillion in retirement accounts.
Ooh,
in the
Thomas,
US.
that's a great
Call
question.
IRA at
The likelihood of interest rates
1-855-FUN-IRAs
increasing and cap rates following the
or
increase
go to our website,
and the impact of the new tax
questira.com.
law.
Are you expecting to close accurately,
It's going to be
on time, and
very
with lots of communication
interesting.
on your home purchase? You've come to the right place. I'm Jennifer Hernandez, Senior Loan Officer.
I'm going to pull this
with
article up.
Legacy
We're going to talk a little bit
Mutual
about
Mortgage.
interest rates when we get
Our
back from the
goal
break.
is to give our borrowers and referral partners an amazing experience during the loan process. My team believes in putting people and culture before results. Our company concentrates on building those teams who operate with structure, process, and recognition for going the extra mile for you. This way, we have the energy to make this your best home purchase ever. Give us a call today to find out the simple steps to get started. I'm Jennifer Hernandez, the Hernandez team at Legacy Mutual Mortgage. Jennifer.legacymutual.com or call 713-579-3611. Again, Jennifer.legacymutual.com. We can't wait to consult with you soon. NMLS 514497.
Equal Housing Opportunity Lender. NMLS 514497.
Are small returns getting in the way of your retirement plans?
Robert, the hot tub's awesome.
There's a better place to invest.
Although I will tell you,
single-family real estate is one of the
it
best
does get
investments you can
real
make.
hot.
Find out how JB
So it is kind of nice when it's cold outside, because when you get too hot, you just get out of it. Then you get back in it. You get out and come back in. And then the other nice thing is, since I got the waterproof phone, it's kind of nice you can work.
281-915-0906. This investment is offered to accredited investors.
Thanks, Robin.
As a real estate investor, you rely on your property inspector to determine the current condition of the home and your potential return on investment from an investor's point of view. Principal Inspections was founded by investor Jeremy Humphrey to do just that. Principal
20
Inspections
seconds.
works
All
from
right.
the investor's point of view, providing affordable, fast, quality inspections with information pertinent to investors while not clouding the report with unnecessary details. Principal Inspections will save you
I got my
time
Red
and
Wings
money.
on today.
Call
I don't wear
Principal
these enough.
Inspections,
I like 'em.
832-684-5516
Of course, it's when it's
or
900
online
degrees
at
outside. It's no fun wearing boots.
principalinspections.com. License number 21264.
This is Business 1110.
Call Jason at 713-785-1817 and look for us on Facebook Live at facebook.com/rightpathrealestate.
Hot mics.
You know what? I'm feeling pretty charitable today. We're going into 2018. I want your 2018 to be really huge, as Donald Trump would say. I want it to be huge. We've got a ton of people who are signed up for the weekend retreat in January. What is the weekend retreat? It's where we show you how we built our business. We run a special on the weekend retreat. If you send an email to support at Right Path Real Estate, we'll let you in on the special price. Again, that's support at Right Path Real Estate. But it's 3 days of me and Tom, the 19th through the 21st of January. It is fantastic. From the experienced investor to the brand new investor, you're going to learn something, trust me. Shoot Veronica an email, support at Right Path Real Estate, and we'll get you in for a special price for taking action today and getting ready for 2018. Again, that's support at Right Path Real Estate. All right. Getting some really interesting questions on Facebook, and I want to go back to this article, and then I want to go answer some of these questions on Facebook because they are incredibly important as it relates to what's going on in the market and the impact on real estate. So I'm reading from Dave Collins' year in review of 2017. It's about 200 pages. If there's only one thing you read all year about real estate investing, or not about real estate, and investing in general, the market, economics, whatever, this is it. He produces it every year. It is absolutely fantastic. Just search David Collins, named Collum, investing. His professional page may come up. He's a organic chemist from Cornell. So if that comes up, that's him. But he produces this fantastic document every year, and I'm reading a little bit from that and discussing what he says here. And I agree with. I'll tell you this right now. I agree with a lot of things that he says. So you're not going to find too much. You're not going to find me quarreling too much with him. Here is this statement. We're talking about all of the money that has come into the capital markets, come into the equity markets mostly. Here's one of his statements. Our system is constantly being overtly displaced from equilibrium by central bankers who view displacement as their mandate. What's that mean? Anytime something goes wrong, we're involved in quantitative easing or we start playing with interest rates. And here's what I can tell you. As that occurs, we are messing with the market. We're messing with the mean. At some point, any natural system regresses to the mean. Even as bad as 2008 and 2009 were, we were not able to regress to the mean. I'm going to read this next statement, and then we're going to talk about it. Warren Buffett's favorite indicator, market cap to GDP, is double the historic mean. I'm going to read that again. Warren Buffett's favorite indicator, market cap to GDP, is double the historic mean. That's what market analysts call historically offensive valuations. Buffett also wrote an article in 1999 stating without qualification that returns are not about the economy at all. Secular bull markets are powered by falling interest rates and secular bear markets by rising interest rates. All right, I want to repeat that one more time so everybody's on the same page. Secular bull markets are powered by falling interest rates. Secular bear markets by rising rates. Got a great question on the Facebook feed. So let me scroll down here real quick. Thomas says, hey, with the likelihood of interest rates increasing and cap rates following that increase, how do you think that will impact the market? And then he has a question about taxes, but I want to take those two things by themselves. This is why I have warned, and Tom has warned as well, as it relates to commercial real estate. Interest rates are at record lows. And I know everybody loves to say, well, Jason, the government can't increase interest rates because they're dead and blah, 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 blah. And I'm telling you, we've got 200 years worth of data that says at some point rates will have to rise. That Class C multifamily deal you're in at a 7 cap with a 5.5% cost of borrowing, that deal is underwater when interest rates rise to 7%. And they will eventually. They have to. It's like fighting against gravity. You're just playing a game right now before you fall flat on your face on the floor. That's really what's happening. Now, the question is, in the single-family market, what happens as rates rise? It depends on the market. It's a lot different than multifamily. Why? Because single-family assets have a retail market. In other words, they have an end-user owner-occupant that wants to buy that house. Here's what we know. As interest rates rise, banks and other investors have a larger appetite for risk. What does that translate to in the real world? What does that mean in the real world? It means people who wouldn't normally get loans are now able to get loans. Meaning, if Joe and his wife Jan have a 650 credit score and $20,000 in the bank, they may not be able to qualify for a mortgage now. Might be a little challenging. However, as interest rates rise, it is likely that there is a bank or an investor that is willing to lend them that money. Now, let me explain what that looks like in the real world. There's not an investor that's going to go out there and give them the money. Here's what will happen. They get a bank loan, and then that bank sells off that note in a package of notes to an investor. Could be an insurance company, could be a big fund. I mean, it just goes somewhere out in the ether as they're looking for yield. That will absolutely happen. As rates rise, lending standards will relax a little bit. They'll become less conservative, which means there will be more buyers for single-family real estate, which will ultimately drive up prices. There's a couple of people that disagree with that notion. I'll just tell you that right now. They'll tell you, oh, because the interest rates rise, people can afford less house, so the price of houses go down. That's true in a greater economic sense. It's not true when you look at certain submarkets. In other words, how many people want to buy their first starter home in Houston, which our median home price in Houston is about $250,000, $250,000, $230,000, somewhere around there. They want to buy their first house, $180,000, $200,000 house, and they just can't get a mortgage because they're beat up a little bit, and there's not an appetite for borrowers like them because the return is not high enough. That's really the problem here. As rates rise, you will see more buyers get into the market, and that's going to increase prices in single-family real estate. What does that also do? In fact, let's take this a step further. Where are these people now? If you can't afford to buy a home right now, where are they? They're either renting a single-family house or they're in an apartment complex. So as interest rates rise and lending standards relax, you are going to see occupancy rates in multifamily housing decrease. At the same time, you're going to see leases that are all-time highs right now. Lease rates are at all-time highs in Houston. You will see lease rates decrease as well. At the same time, cap rates will be increasing. A lot of people seem to think, and I see the pro formas in these PPMs because I get sent them by multifamily people all the time. They are not prepared for this trifecta of a downturn. And what does that trifecta look like? Rising interest rates, increased cap rates, and then, of course, decreases in occupancies. All of which then result in, typically down the line, decreases in leases.
2 minutes.
In fact, you can see that now if you drive around town and see all the sign flippers in the streets that are saying, go to this apartment complex, 2 months free, waiving the security deposit, all that stuff. It started before the storm. It started about a year ago. So it's already happening. That's before we have a reset of interest rates. So I think if you're a multifamily investor, you ought to start to get pretty concerned here. Here's the other thing most multifamily investors miss. There's interest rate risk and there's refinance risk. In the single-family world, if you're a buy and hold landlord, we advocate 30-year mortgages or a 15-year. Whatever your AM is, it matches the term. That way you don't have to get a new loan. Like you are done getting a new loan for that property. That's it until the property's paid off or sold. Most multifamily deals are 5 or 7 year balloons. What happens when you have to refinance that loan and there's no appetite for multifamily credit? You're getting foreclosed on. And I've seen it happen before in the middle of the credit crisis. We get back from the break. We're going to talk more about the year in review and what 2018 looks like. It's Jason Bible, Right Path Real Estate.
Mike's off.
You found or inherited a great investment property. Problem is, you don't know how much it's worth, or more importantly, what to do to maximize your investment while mitigating risk. This is exactly why we started Next Gen Appraisals. Next Gen is a group of appraisers specializing in investment real estate. We understand that investors aren't just looking for a number of what their property is worth, but a comprehensive analysis of the market. Give Next Gen a call at 713-346-9911 or check us out online at nextgenappraisals.com.
Hi, Clint Coons here, attorney and avid real estate investor. You know, the greatest mistake real estate investors make is not understanding the potential liability that exists from owning real estate. At Anderson Business, Legal, and Tax Advisors, we specialize in protecting real estate investors in all 50 states. In addition to structuring your business for optimum protection, we provide guidance so you pay the least amount of taxes available under the law. We have 150 employees that range from lawyers to CPAs to estate planners and much more. Download our free ebook, The Invisible Investor Strategy, today at AndersonAdvisors.com or call for a free risk reduction analysis and financial blueprint at 800-706-4741. Anderson Business Advisors will help you keep more of what you earn. Call us today at 800-706-4741 and mention Right Path Real Estate.
Selecting a foundation company and their product for repair is a lot like a game of chance. You simply don't know what you're going to get. The foundation repair industry as a whole doesn't.
So, Thomas, hopefully that answered your question. As far as the tax stuff, I don't know. I'm going to be on a webinar first week in January with a buddy of mine who's really great. He's a fantastic attorney, and he's a CPA. And I will know more then. So it's going to be interesting. I'll tell you that.
As a real estate investor, you rely on your property inspector to determine the current condition of the home and your potential return on investment. Principal Inspections was founded by investor Jeremy Humphrey to do just that. Working from the investor's point of view, Principal Inspections will give you turnkey inspections that are high quality.
I'm ready for the weather to just pick one thing. It's going to be cold or hot. It keeps doing all this stuff on my signs. It's driving me
Jeremy
nuts.
Humphrey comes from a family of real estate investors. He started Principal Inspections for investors because as an investor himself, he experienced the need for fast, quality inspections with information directly pertaining to property condition and potential resale value. Principal Inspections will save you time and money. Call Principal Inspections, 832-684-5516. That's 832-684-5516. Or go online to principalinspections.com. That's principalinspections.com. License number 21264.
Are small returns getting in the way of your retirement plans? Why settle for mediocre results? There's a better place to invest. The experts agree. Single-family real estate is one of the best investments you can make. Find out how JB Fund Services offers a 9% preferred return and up to a 13% waterfall. Call us today at 281-915-0906 or visit our website, jbfundservices.com.
I could have sworn I had something this
afternoon.
afternoon.
281-915-0906. This investment is offered to accredited investors.
Are you a realtor or seller that is
30
concerned
seconds.
about the new TRID rules and closing on time? I'm Jennifer Hernandez, Senior Loan Officer at Legacy Mutual Mortgage, and we have mastered the 30-day close. We close on time, accurately, and with tons of communication. You'll have a dedicated team of a coordinator and a contract-to-close associate. Give me a call today at 713-579-3611, and let's talk about how we can help you on your next transaction. NMLS 514497.
This is Business 1110.
Call Jason at 713-785-1817 and look for us on Facebook Live at facebook.com/RightPathRealEstate.
Hot mic.
Welcome back. Jason Bible, Right Path Real Estate. I'm going to read the rest of this article, this section of this article. Bull markets are powered by falling interest rates, bear markets by rising rates. With interest rates at multi-century lows. I'm going to read that again. With interest rates at multi-century lows, it seems likely that Buffett knows that his implicit reliance on the Fed's valuation model is lunacy. As an aside, Berkshire Hathaway has the largest cash hoard in its history with $100 billion, and it's not being used to buy stocks that are on the cheap side. Warren Buffett had said earlier this year, measured against interest rates, stocks actually are on the cheap side compared to historic valuations. No, they're not. No, they are absolutely not. We are in a very weird time. We've just experienced 12 months, not a single month of negative growth on the capital markets. The Dow in particular. Look at QQQ and how it's evaluated. Look at that price to earnings ratio. Look at the S&P. Everything is at historic highs. Absolutely historic highs. And the question is why? Well, there's $200 trillion sloshing around in the system. And where does that money go? It ends up somewhere. Some of it has absolutely landed in real estate. And $200 trillion, you think, oh yeah, the single-family real estate market. All that money went into single family. You have any idea how hard it is to put $100 million to work in single family, let alone $200 trillion? I'll tell you where that $200 trillion went. It went into the equities market, and it went into commercial real estate. When you're doing 40, 50 million, 100, $200 million projects, it's pretty easy to sink $100 to $200 million a time into commercial real estate. That's a lot harder in single family. It's easier to buy the notes in single family, a lot harder to deploy to buy houses. We had a conversation with a couple of banks earlier this year, right after Hurricane Harvey. They wanted to bring $250 to $500 million in the next 12 months into Houston to take advantage of what's going to happen in these neighborhoods as prices decline. And I laughed and I said, $250 to $500 million? Are you kidding me? You know how much money that is? $100,000 at a time? That's a ridiculous number of houses. It's 2,500 to 5,000 houses. Do you know what the kind of business you've got to set up and what kind of operation you have to set up to buy that many houses?
1 minute.
These hedge funds that come down here can hardly rehab. They can hardly buy, rehab, and rent 40 to 50 houses a month, let alone doing that in a handful of months. Forget it. No way. No way. So you got to wonder, where'd all that money go? Ended up on these other balance sheets. So what's that mean for 2018? I will tell you guys all about that next Wednesday and next Friday. I want to thank you guys for listening. Thanks for coming to the events. Thanks for making Right Path Real Estate one of your homes here in the morning. Hope to see you guys in 2018. Have a Merry Christmas and a Happy New Year, and we will see you next year. So Jason Bible, Right Path Real Estate.
All right, Mr. Bible. Have a Happy New Year.
All right, you too.
Bye.
Bye.
You've been listening to Right Path Real Estate Radio. Find Jason and Tom at